Advanced Micro Devices, AMD, has just reported, and they are up big after hours, as they should be, because they reported 96 cents, beating estimates of 93 cents, and they reported 7.4 billion, beating expectations of 7.12. Now, as you can tell after hours, they're up $4.74, about 5%. Now, actually, the funny thing about AMD is they've actually been pretty consistently flat. I mean, they hit 100 back in September of 21, and that's almost 4 years of nothing. Yes, they've gone up and down, which is the way things go, but from a long-term perspective, it's gone nowhere. But what's interesting is, in 2021, let's see how they did back then in the quarter. So the quarter, September 2021, we're looking at a quarter of 4.31 billion and profit of 900 million. They just brought in what did we say? They just brought in 7.4 billion and profit of 96 cents per share. They have $1.2 billion. Huge quarter, but the stock is flat. So there are a few ideas of what that means. The stock was overpriced before. The stock is massively undervalued now, somewhere in between. This is what we talk about in the fourth tenet of our principle-driven investing. In the short run, stocks are a voting machine. In the long run, they are a weighing machine. This is very popular, made by Ben Graham. Stocks that are popular in the short run will go up. Stocks that are hated will go down. But in the long run, what's going to drive value? It's going to be the fundamentals of the business. As they get better, the business will do better as long as you pay a reasonable price. Because the fifth and most important tenet of our principle-driven investing is a great story at a wrong price becomes a bad investment. You must pay the right price. If you don't pay the right price, you're going to do a bad job. Now, with AMD, they're reporting this. Let's look at their 8 pillars real quick before we go into their actual report. 3 X's, 5 checks. Net income growth, revenue growth, cash flow growth, low debt, high ROIC. Now, some things I don't like. 35% more shares. They're diluting people. And guess what? I don't blame them. They're probably like, listen, our stock is popular. Let's give the people what they want. 35% more shares since that quarter that I just reported back in 2021, a little bit before that. But look at these ratios. 5-year PE, 5-year price to free cash flow are very high, 75 and 85. And look at their current free cash flow multiple, 67. Current earnings multiple, 98. And they also generate way more free cash flow than net income, which I do like. Last year, in the trailing 12 months, it did 2.4 billion in free cash flow. But here's what's interesting. The last 5 years, their average was 2.1. Now, this is a chip industry. It's growing like crazy. They're doing great things out there, and they're nipping on the heels of everybody. Question is, can you pay a reasonable price for that? This seems expensive at $67 times free cash flow and 98 times earnings. What does a company have to do to justify that valuation? In and of itself, it means nothing. But if you're going to look at that, you have to say, okay, well, in order for me to pay a premium, I've got to either have amazing security, where it's such a big company and ingrained in our lives that people can't give up having it. They have to have this. It's going to be around forever. But even then, this much of a premium, the market average is going to be 15 or 17 earnings and free cash flow. They're at 67. Something's got to give. Now, they have massive growth. If you told me today, Paul, AMD is going to double its profit every year for the next 10 years, I would pay this in half a second. Because look, 2.4 billion in free cash flow becomes 5 billion, becomes 10, becomes 20, becomes 40, becomes 80, becomes 160, becomes 320. Do you get my point? We're not even there yet. Becomes 640, becomes 1.28 trillion, becomes 2.56 trillion dollars. Would you pay $161 billion today for a company that generates 2.56 trillion in free cash flow in 10 years? We obviously see the extreme example I just gave, but that extreme example helps us realize that there's somewhere in the middle that makes sense. It's probably not here, but let's go check out their earnings release to see exactly what they're talking about here. All right. They announced financial results for fiscal 2025. First quarter revenue, 7.4 billion. Gross margin was 50%. Now, this is important. I own Intel as a turnaround play. I look at this saying, okay, if their gross margin is 50% here, that's something I want Intel to really look at. Operating income was $806 million. Net income was $709 million. How did I get the 1 billion then? They have 1.6 billion shares outstanding. Oh, right here. Sorry. Net income was 1.6 billion and diluted earnings per share were 96 cents. We delivered outstanding start to 2025, grew the first quarter revenue 36% year over year, and delivered significant earnings leverage. Lame word. I'm going to just scratch out leverage because every douchebag finance bro in the world says leverage. We grew first quarter revenue 36% year over year. Guys, do you know how hard this is? That's so hard. That's a great performance here. And look right here, trailing it out. Q1 2025 versus 2024 year over year change versus Q4 2024, that's quarter to quarter change. Here's what's interesting. Look at how much is down from last quarter to this quarter. A lot of things down, but look at how much it is from the previous year. Everything is up. That's incredible. Big stuff here, guys. Big stuff. Diluted earnings per share, yeah, incredible. Non-GAAP. Data center revenue has to do with AI. $3.7 billion, up 57% year over year, driven by the growth in AMD, this EPYC CPU, and the GPU sales. And that GPU is the famous chip that's big for AI that NVIDIA is actually killing it on. So we've gone over this. We've gone over the company a little bit high level. This is where we need to put the numbers and the story together to see how they can work together. So we're going to go to our stock analyze. Well, let's actually see what analysts are saying first. I want to cover analysts. Analysts are estimating $467 this year in earnings, growing to $1171 in the next 3 years. That's 2.5 times. 2.5 times growth in their earnings per share. And that's a premium business. It needs a premium. How much of a premium? Revenue growth, 23%, 20%, 15, 28. Now, granted, you got to keep in mind, there's only 2 analysts here at the end. So keep that in mind when going forward. Now, I'm going to go over a couple things here. First off, if you're a fan of AMD at 103, there is a way that you can buy AMD at a cheaper price, a lower price than today, and also get paid for that. So you're sitting there saying, hey, listen, I want to buy AMD for $95. There's a way to sell a cash secure put that allows you to buy AMD at $95, be paid for that right, and if it falls to 95 or below, you get the stock at $95. If that's of interest to you, this is something that I do routinely. This is something that a lot of investors do to get paid to buy stocks they want at lower prices. It lets you get paid to root stock prices down. If that sounds interesting to you, May 15th, we have a great class starting where we're going to teach you cash secured puts and covered calls. This is something I've been doing for the last 55 years, 60 months. I've had only 3 down months. Now, obviously, your performance is going to differ, but it's a great way of generating income on stocks I own, as well as generating well above the 4% return I'm getting in my cash, generating 10 to 15% returns on my cash. Sounds too to be true. It's all about your approach to it. If you're using it for the right reasons, you can do great. Click the link below. It's a great class. And the great part is you sign up for the class, you get all of our software for 1 year for free. So check that out. Now, our stock analyzer tool is going to put together the story and the numbers. Let's see what I have for AMD going forward. Well, first off, let's make this bigger because I want you guys to be able to see this. I did a 10-year analysis. First line, revenue growth. 8, 12, 16% revenue growth. That's a lot of growth in the next 10 years. I'm being aggressive there. Profit margin, I did 8, 15, and 22. Guys, I did this because of Intel. Intel was making 20 to 22% bottom line profit when they were a stable company for the previous 20, 25 years until recent. Keep in mind, they've never done this before in the last 10 years, or actually ever. They are well below that. So I'm giving them a premium to their last 5 or 10 years. So keep that in mind when you see the numbers pop up. PE. What's a reasonable PE for this company in 10 years? I put 18, 21, and 24, and I put a 9% desired return. 9% is not enough. It's the market return. It gives you basically what your intrinsic value is. But you need to get a higher margin of safety because you're buying individual stocks. The future is unknown, and we're humans and make mistakes. So when you're using this software, you've got to put in a higher return than 9%, or you might as well just buy a low-cost ETF. We're going to hit the Analyze button. Keep in mind, I'm going to repeat this till I'm blue in the face. These assumptions the company has not done a lot of these assumptions. So it's quite, sorry, these assumptions right here have not been done. You've got to keep that in mind with this aggressive price. I hit the analyze button. Here's how overpriced I think AMD is. Low price of 31, high price of 200. My middle price is only 90 with very high assumptions. Guys, again, this is what's great about the software. It allows you to make your own assumptions. I will see you May 15th for that class so you can go kill it. Thank you for your time.